My name is Vanita and welcome to today's session of Atma Network webinar series. In keeping with our efforts to help NGOs, the Atma Network uses this webinar series as a platform through which subject matter experts help organizations with best practices so you can manage your NGOs more effectively and impactfully. So today we are going to address a topic chosen through a popular demand, income tax for NGOs. To enlighten us about this very essential topic, we have two very experienced and enterprising speakers with us, Suhail Goel and Dhaval Kodilkar, who both are from the firm Sunil Goel and Associates. Mr. Suhail is a fellow member of the Institute of Chartered Accountants of India. At the age of 22, he achieved his accountancy degree with distinction from the American Institute of Certified Public Accountants. Besides the degree of Chartered Accountancy from the ICAI, he holds a brilliant academic record, being a gold medalist at higher secondary education and bachelor's in commerce with distinction from Delhi University. Mr. Suhail Goel oversees the personal and corporate tax advisory services beside advising on issues related to cross-border transactions with a special reference to double taxation avoidance agreements and advisory on foreign investment into India. He also supervises the firm's assurance practices and litigation services before the tax authorities, Reserve Bank of India, and Ministry of Home Affairs, and seeking approval from the Ministry of Finance, DIPP, and Ministry of Corporate Affairs. Dhaval is an associate member of the Institute of Chartered Accountants of India, ICAI. He oversees the firm's Mumbai operations and is also a taxation and FCRA expert, having in his portfolio advisory to a number of local NGOs, including existing partners from the Atma network. He has been assisting NGOs with their needs in the areas of taxation, assurance, and general compliances, etc. Besides advising on the entry strategy to India. In addition, he has been advising such entities for their needs to set up proper internal structures with a view to achieve long-term financial and organizational stability. But before we head on to the session, let's recap a few basic rules. All attendees are requested to stay in the listen-only mode. Please mute your microphone so we can minimize your audio disturbances. Any questions that you may have will be taken up in our Q&A section towards the end of the webinar. So please type your questions in the chat box that you see on your screen and do keep the questions coming. A topic like income tax will be better understood only if you raise specific challenges that you and your organization is facing. And last but not the least, after the session, we will mail all attendees the presentation that you will see today and any other additional resources relevant to this topic. Well, that's it from me. Over to you, Suhail and Dhaval.
Good morning, and thank you so much, Vanita, for this wonderful introduction and organizing another of the webinar series for different NGO partners of the Atma network. We're extremely happy and privileged to be speaking to the various NGOs across the country. And I noticed that we have several members who have already joined in. So thank you, everyone, for taking the time out on this morning to be part of this session. What we intend to accomplish in the next 40 to 45 minutes is to basically give you a high-level summary of the important terminologies, the important laws within the income tax framework, and also some of the key elements that you need to be aware of when you are managing your registration as well as ongoing tax compliances. In the initial bit, the first 4 or 5 sections, we will talk about some important concepts which you need to be aware of, while towards the middle of the presentation, we'll go into the nuances of how to register yourself as a tax exempt entity. And then finally, just try and take up some practical bits with case studies, as well as most importantly, trying to help you address some of your questions. The most important aspect is for you to appreciate and understand what is the meaning of a charitable purpose. A charitable purpose is defined as per Section 2, subsection 15 of the Income Tax Act. This definition is an inclusive definition, and to highlight, this definition varies significantly from what the charitable purpose is defined under other statutes and, more importantly, the GST legislation. It's important for you to understand what are the different aspects which are covered under charity per the tax laws versus those which may be covered under indirect tax laws like GST. Coming to this relevant definition, as per Section 2, subsection 15, a charitable purpose includes relief of the poor, education, yoga, medical relief, preservation of environment, which is where we're seeing a lot of traction in the last few years with significant enlargement of the coverage of this particular clause, preservation of monuments, and then again, this is a generic clause, which is advancement of any other object of general public utility. It's extremely important for you to get to classify yourselves under the right terminology when you're applying for your registration and when you're drafting your charter documents. You want to make sure that if you are providing a mix of different activities, then the most relevant activity should be classified as the charitable nature. Moving on, to avoid any sort of confusion, we're trying to give it in simpler terms that if you are carrying on any activity or rendering any service in relation to any trade, commerce, or business for fee, irrespective of the nature of application or retention, then typically you will not be considered as a charitable purpose. However, if such activity is for advancement of any other object of general public utility and those ancillary activities receipts are not exceeding 20% of the total receipts, then you will still be classified within the meaning of the charitable purposes. As an example, if you're running an educational institute and you're also leasing out your premises for, let's say, coaching services, or you're letting it out in terms of providing an ancillary element which is going to be relevant for education, and the total receipts are less than 20% of your overall education receipts, then you will still be considered as a charitable purpose. Another important bit that you need to spend a minute is to understand what is the meaning of income and how that income is either exempt or in certain cases it may end up being taxable. Typically, Section 2, subsection 24, Clause 2A would define income, which includes voluntary contributions. It would be income from property held under a trust. It could be capital gains from sale of any asset properties of the trust. And finally, anonymous donations. All four of these elements would typically end up resulting in an income to the charitable trust. And then to understand whether the income is taxable or not, there would be two or three limbs, which means that if there is a voluntary contribution with a specific direction to form part of the corpus fund, in that case, the donation is treated as an exempt income. However, if it is a voluntary contribution for a general purpose, then it continues to be a regular income of the trust. Another example to this would be if you receive a particular grant to develop an infrastructure, which means, let's say, a building fund or a specific fund towards a relief for some natural calamity, then that would typically go into the corpus or will go into a designated fund, and thereafter it would be an exempt income. When there is a regular income in the nature of a voluntary contribution flowing to the organization, the income tax laws allows for 15% of such property or such income to be exempt without any other conditions. So what the tax statutes say is that out of, let's say, 100 rupees that you receive, 50% is automatically treated as exempt, and there is no conditions to that. The remaining 85% is what you ought to have applied, which means you ought to have spent this money during the year. In case you have not applied or you have not spent this money, you could either accumulate that for certain specific purposes, which means you need to intimate the tax authorities, or else if it has not been accumulated for a specific purpose in India and it is also not being spent, in that situation, it will result in having a tax liability for the organization. Anonymous donations is another important topic for you to understand. The word anonymous, by its dictionary meaning, would obviously mean that you do not have a record of the source from where the money has been received. Therefore, to give an illustration, if there are a lakh of rupees that you have received anonymously, then you would be given either a 5% exemption of your total donations or rupees 1 lakh, and the balance amount would be taxable at 30%. The only exceptions, which are if such trust is being established wholly for religious purposes, in that case, anonymous donations are fully exempt. And typically, as an example, here you mean the charity box or the donation box, which are placed in a place of worship where typically any of the people visiting the place of worship would not like to disclose their identity, and they simply put the money in the donation box. Those kind of organizations are not required to maintain records of the identity. Uh, as a summary, what we would always advise all organization is that they need to maintain a record of the identity, which means the name and address of the donor, and such other particulars which are prescribed from time to time by the authorities. And by this, we normally suggest that you keep a copy of their PAN card or proof of identity, or if there is a corporate donation which has come in, then a copy of their memorandum or articles, or for that matter, certificate of incorporation, or any other document which proves the identity and genuineness of the source. By application of income, we typically mean the spending of the money which you have received. One of the important things for you to understand is that all monies typically ought to be applied or to be spent for charitable purposes within India. And we've deliberately called out the in India as a separate color. A lot of time organizations are confused when they're remitting money overseas, or if they are engaging a foreign consultant or a foreign company, that whether that application of money will be allowed. The general rule, the general thumb rule would be that you need to spend the money within the geographical boundaries of India. The various sources where you can spend this money would be towards purchase of capital assets, which means, let's say, projectors, tables, chairs, any other asset, including laptops, computers, anything which would be required for engaging your staff and for providing those charitable activities. The repayment of a loan which would have been taken separately in the past. Any regular revenue expenditure. A revenue expenditure would mean salaries, administrative costs, rents of different premises, communication costs, travel and conveyances that you would be spending, or any other legal and professional charges. And then finally, if you've made a donation to another registered organization or another registered NGO, that would also be treated as an as an allowed spend of the money during the year. The tax authorities also deem in certain cases that a money has been spent. Those purposes would be in case you have not actually received the money during the year in your bank account, which means that an organization has committed to pay you the money. They have probably issued you the check as well, but the check did not clear before 31st of March, and therefore that income would not actually be deemed to be applied for the subsequent year, but effectively the year in which the money has been realized, that's where the money will eventually go to. Or if you submit a declaration to the tax officer that the income for the year will be applied in a subsequent year. So if you're unable to be spent the 85% during the fiscal year, then you can always go to the tax officer before filing a return and tell him through the appropriate form that you've not managed to spend the money during the year and you intend to spend it in future years, and you will be allowed to accumulate that for a subsequent period of 5 years. Talking about the accumulation of income, the income which has not been spent during the year could typically be accumulated for specific purposes in the future. It would be exempt in case the following conditions have been fulfilled. That means that the organization has filed the relevant form with the tax officer stating the period and the purpose for which the money will be accumulated and spent in the future. And the money has also been deposited or invested in specified bank accounts or specified asset forms as have been defined in Section 11. You are not obviously at liberty to use the money any way that you would want or invest it in, let's say, equity market or stock to your convenience. There is a restriction in terms of what would be the sources in which you can invest the money. In case you have accumulated the money and you have not managed to fulfill such conditions, it will be taxable, where if you have used it for a purpose other than the purpose for which it was accumulated, it would also be taxable if you fail to invest the money in the appropriate accounts, and if you have not utilized the money in a period of 5 years immediately succeeding the year of accumulation, or you have donated it to a trust or organization registered. That means you have yourself not utilized that money. The following are the investments in the specified mode that we just spoke about in the previous slides. You could deposit the money which has been accumulated in only the following instruments. You cannot go into any other form of investment outside the ones that you see on this slide. What we'd like to specifically call out is that any money which is obviously lying with a scheduled bank or with a post office savings bank, that's fine. You cannot go ahead and invest money into the stock market, as I was suggesting earlier. However, you are allowed to invest into the securities issued by the central government or the state government. In essence, what this slide tries to suggest is that the money needs to be invested in secure modes. You cannot leverage this money and speculate it by investing into risky sources. I'd like to hand over now the rest of the few slides to my colleague Dhaval. Dhaval, if you can just carry forward from now.
Yes. So thanks. So now we got a fair idea of what exactly the charitable purpose is, what is the income, and how we can invest that income in case of an excess. So what are the modes where we can accumulate those income? Now we'll move on to the some of the exceptions in case where the section 11 is not applicable, which means the trust will not get an exemption for the income for the particular year. So following are the few of the cases wherein the section 11 exemption will not be applicable to a trust. So in case any of the trust is engage in the activities which are only for the private religious purposes and which does not ensure the benefit of the public. So in those cases, the trust will not be eligible for an exemption of Section 11. So another exception is regarding if a trust is completely engaged in a particular religious community or a particular caste, then those are also some of the cases where the Section 11 exemption will not be applicable. So, and there are another two exceptions, which includes where the part of the income of the trust or any property of the trust is used for the benefit of any person who are specified under Section 13, subsection 3, which includes the related persons of a trust. So, if any funds you are utilizing for the benefit of those persons, again, in that will also not allow you the exemption under Section 11. And as we gone through the previous slide, if you do not invest in the modes which are specified under Section 11, subsection 5, then in that case also the Section 11 will not be applicable and trust will not get an exemption. So now let's just understand who are the specified person for the trust. So, as we understood that if any of the funds of the trust are utilized for the benefit of the specified persons, then that will not give the exemption to the trust under Section 11. So the related persons includes the following people, which includes the author or the founder of the trust, any person who has a substantial contribution to the trust, and the substantial contribution, which means if they have contributed more than 50,000 rupees in a relevant previous year. Then in case of any author, founder or a person, if he's a HUF, then a member of any HUF is also a related party. Then any trustee of the trust or the manager of the institution is also a related party. Then any relative of such a author, founder, person, member, trustee or manager as well are a related party to the trust. And in case any other concern in which any of the person who are referred in the above five clauses, if they have a substantial interest, in those cases also all of this will be considered as a related person. And in which case, if you are applying any funds of the trust to the specific benefit of this person, then that will become taxable and the trust will not be eligible to get an exemption under Section 11. So let us understand now what are the registration process and procedures under the Income Tax Act to get the registration under Section 12A. So first and foremost, we need to understand that to get an exemption under Section 11, every trust needs to have a registration under Section 12A. So the procedure for need to apply for a registration under Section 12A to the income tax authorities in Form 10A, and there are specific documents which needs to be submitted to the income tax department, which includes the instrument of the trust, their registration certificate, their annual accounts of the audited accounts of the trust, and a note which includes all the activities of the trust that they are carrying out. So once we file the application with the income tax authorities, then it will be filed online and it will be verified by the income tax officials. And one of the major amendment which came in the last year budget was, so earlier the registration process was much easier, but now it has become more stringent as the tax officials will have to satisfy themselves that the trust is doing the charitable activities, and only then they will be allowing the registration.
Is that you earlier only needed to prove that your objects were genuine, which means when you went in for registration, as long as your purposes and objects were charitable in nature, then typically the tax officer was obliged to give you registration. Versus when you now go in for registration, you also have to prove that you have actually spent monies and you have actually engaged in those purposes, and therefore it is very essential that you needed to have carried out some charitable activities, and you needed to have performed those events or performed those seminars or any other bit that would be covered within the charitable definition, and submit copies of some photographs, copies of invoices of monies that you would have spent, and any other relevant proofs that you can before you are actually granted registration. So that's a very fundamental difference compared to the previous registration process. Dhaval, if you can carry on now.
So let us now go through the registration process for Section 80G. So the Section 80G entitles the donors to get their tax deduction under their tax return filing. So there are few conditions for the registration under Section 80G, which are more or less similar to the registration conditions for Section 12. So one of which includes that the application, once we make to the income tax department, so we need to ensure that whatever the activities which are carried out by the trust are as per the charitable purpose which are mentioned in section 2 subsection 15. Then we need to ensure that the trust is utilizing all the donations for the respective purposes. None of the funds are utilized for the specified person who are related parties of the trust. And the trust should also ensure that the in case there are any businesses which our trusts are carrying out apart from the charitable activities, then the accounts for that activities are maintained separately, and there are no donations which are utilized for the other activities. Then moving to the procedure of registration. So for obtaining registration under Section 80G, an application in Form 10G is to be made to the Income Tax Department along with the documents which includes the instrument creating the trust and PAN card, their audited accounts, their registration certificate, and the proof of the welfare activities pursued by the institution since the inception of the trust. Once these documents are submitted to the tax officials, so it will be scrutinized by the commissioner of the income tax, and on his satisfaction, the ITG registration certificate will be issued to a trust. Then let us understand what are the income tax compliances and the various forms that the trust needs to file with the income tax department. So these are the various forms we have enlisted here, so which will give you a fair idea of what are respective forms are to be used for the respective purposes. So for application for grant of approval under section 1023, the trust needs to apply in form 9. Then for the exercising an option of section 11, you need to apply for section 9 under form 9A. So, and Form 10 is basically when a trust has excess funds, then they need to apply to the income tax department under Form 10 and get a permission to accumulate those funds in the future years. Then for registration of a charitable trust under Section 12A, you need to apply in Form 10A. Then the audit report, which every trust needs to get their accounts audited, and the audit report under Form 10B needs to be submitted to the income tax department. The same way, if you are registered under Section 1023C, then the audit report needs to be submitted to the income tax department under Form number 10BB. And as we've gone through the for registration under Section 80G, you need to file Form 10G with the income tax department to get approval under Section 80G. So there are a few recent amendments which you have covered, which came in the recent Finance Act 2018. So there are major two amendments which came in. Is the one of which is failure to deduct the TDS will be resulting into the disallowance of expense of 30% for the trust. So whenever you are making any payments to any parties, let's say I'm making a professional fees payment or any salary payments, so the trust need to deduct the TDS at source. at the time of making payment to such parties. And in case if a trust fails to deduct that TDS, then there is a 30% of that sum will be disallowed as an expense to the trust. Then the second amendment talks about the cash payments. In case if trust makes any cash payments to the any parties which exceeds rupees 10,000, then entire expense will not be allowed under the Income Tax Act, and the trust will have to pay tax on such disallowed expenses. So that's particularly to restrict the trust and to use as less cash as they can, and to ensure that the entire payments are made through electronic transfers. So here we have covered few of the case studies which will give a fair idea that even though the Income Tax Act, it has a stricter meanings, and but there are few case laws which also lays down the exact flavor of the act and the provisions enlisted in that. So this case study talks about the welfare schemes of government which are run by the charitable organizations. So, so one of the case of Anandan Trust. In this case, the assessee trust was engaged in the implementation of welfare schemes of the state government. So the trust was in the activity of supplying food to a poor school children on the funds which are received by them from the state government. So in all scenario, the trust might think that since they are doing some relief to poor, so they will get the charitable status and claim an exemption under Section 11. However, the High Court of Kerala ruled otherwise. So it was held that since the funds were given by the state government to the charitable institution, and all they were doing is to obligation towards the contract which was given to them by the state government. Hence, it was held that this will not be considered as a charitable activity, and the trust will not be entitled for registration under Section 12A. So the another case study that we have covered, it talks about the seventh leg of the section 2 subsection 15, which talks about the objects of general public utility. So in this case, the Pradhan organization was engaged in the activities of upliftment of poor, and providing training and skill development of the poor in rural areas in the backward districts of states like Bihar, Jharkhand, etc. So the trust was engaged in these activities of relief of poor as well as skill training and skill development. So in order to carry out their activities and to have some cost covered from the project, so trust used to charge few of the amount to their beneficiaries and to cover the actual cost of the project. However, there was no profit element included in those fees charged to the donors or the clients. So in that case, it was held that even though there is the trust is only recovering a cost and there is no profit motive involved in it. So it was held that even though the activity comes under the trade, commerce, or business, it still will not be considered as it will still not be considered as a trade or for a profit motive, and still the trust was eligible to claim their exemption under Section 11. So this gives us an idea that even though if I'm doing the activities in the nature of trade, commerce, and business, but in case I'm only doing it for pure charitable purpose without any profit motive to it, then the trust can still claim an exemption under Section 11, subject to the conditions that we studied earlier. So another case study that we have covered, which squarely covers the investments in the specified modes that trust needs to do. So in case of excess funds available with the trust needs to accumulate those funds to spend in the future years. And in case of such accumulation, the trust needs to invest those funds in the specified modes given under Section 11, subsection 5. So in the case of Shri Gokulan Trust, so the SEC had surplus funds, and what they have done, they have invested in the chit fund, which is not exactly the specified mode mentioned in Section 11, subsection 5. So in such case, that investment in chit fund, since it's not one of the specified modes, it was held that the entire investment is not eligible for the accumulation, and the trust had to pay taxes on that, and they were not able to claim an exemption under Section 11. So that gives you an idea that even though you have any excess accumulation, you need to ensure that all the funds are invested in the specified modes as mentioned in 11 subsection 5, and 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 to ensure that there is no violation of the income tax provisions. So that's it from our side. So we will take up the questions from the attendees.
Thank you so much, Suhail and Dhaval, for all that information about income tax. We are now opening the round for Q&As. Please type your questions in the chat box. We are going to take the questions that have already come in. So, Vandita is asking if we conduct courses towards our objects, which is gender justice, education, etc., but charge for these and income tax exceeds 20% of our total income, is it not considered charitable income?
So Monica, so there is a quick limit which has been given under the Income Tax Act that your income from any other objects which is in the nature of trade or commerce that shouldn't be exceeding 20% of your total receipts. So even though if it's exceeding 20% of total receipts, the amount which is exceeding 20% will be taxable under the income tax.
And Dhaval, just to add to what you had said, well, Vandita, what is also important to understand is that course, yes, it is education or it might be towards gender justice, but what is the ultimate object of that course? If it's for something to do with a charitable nature, which means that if you're promoting gender parity, or if you're promoting objects which would be covered under the charitable purpose, and if you're charging fee for those activities, that would still be allowed as an exemption, which means if it's a school and a school is conducting a course, which means is providing education and is charging fee, that is not excluded. But the difference comes in is where it's a coaching center and that coaching center is providing education, that becomes an object which is profitable in nature and not charitable. So therefore, from your question, we're unable to appreciate whether the ultimate objective is profit making or charitable in nature.
I hope it answers your question, Vandita. The next question is from Gautam Sood, who's asking, maintaining records from donors could be an issue in case of crowdfunding. How to tackle that?
I'll take that question, Dhaval. Gautam, that's obviously a very valid point, and that's a common struggle. Unfortunately, there is no way out. The law is very clear in terms of anonymous donations, and from our understanding and our experience working on different funding platforms, typically the name and particulars of the ultimate donor are available to the platform. It is not an absolute anonymous donation. So depending on what platform and what kind of funding this has managed to raise for you, you will have to work out a system to ensure that you have these particulars. Alternatively, the limits which we've already shared with you, 5% of your total donations or rupees 1 lakh, whichever is higher, you need to ensure that the crowdfunding gets restricted to those amounts.
Thank you so much, Suhail. The next question is linked to this question asked by Devika Sen, who says, we are an FCRA registered organization. As our bank details are registered with various online portals, sometimes we receive donations from Indian donors in FCRA account without prior information. Is there any issue in this?
Devika, to address this, yes, you are not supposed to be receiving any local grants into the FCRA account. And if you have publicly shared your bank details One, you should try and avoid that. If that's not possible or feasible, then the only alternative would be either to return those monies, or else you'll have to go in for voluntary disclosure when you're filing your annual returns, and voluntarily telling the tax authority, the FCRA authorities, that this is an error. And if they are willing to overlook that, then you could get the offense compounded. Otherwise, very clearly from the FCRA provisions, this is a violation of the statute.
Thank you so much. The next question is from Vishal, who asks, do expenses incurred by trustees on travel and boarding while attending conferences abroad or in India considered exempt expenditure?
Vishal, this is a very common question that we receive. Um, there is case laws which are prevalent which support the fact that since the ultimate benefit of this foreign travel are to entity or to the charitable purpose in India, then such exemption or such expenditure should be exempt. However, those case laws should only be relied upon in case this is something as an error or an oversight which has already been made. But from a planning and an advisory perspective, we would typically advise you not to spend overseas, and instead the travel and boarding should be paid to an Indian travel agent who may ultimately allow for that to be spent overseas. But the physical check or the money transfer should not happen outside India. It should be to within the boundaries of India.
Thank you. The next question is something that you've already answered, but would you like to take this again? Santosh is asking, GST is mandatory for organization donation more than 20 lakh or not?
Dhaval, if you'd like to take that.
Yeah. So Santosh, see, the donations are not strictly covered under the turnover definition under the GST. So as long as you are receiving the donations, so that will not covered under the limit of 20 lakhs. However, if you are receiving any other receipts which are not the donations, then for that we need to check the turnover limit of 20 lakhs.
Okay. I hope that answers your question, Santosh. Ajit is asking 15% of accumulation calculation. Is it on gross receipts, that is grants, general donation, FT, interest received, etc.? If you can also clarify this question, I'm not sure if I.
Yes. So Ajit, yes, the 15% accumulation you need to take on the total receipts of the trust. So whatever the receipts, whatever the incomes that trust has received, be it the grants or general donations or FD interest received or any other income, so the 15% of that will be a straightforward exemption.
Thank you so much. The next question is from Praveen, who asks, which conditions do we need to file 9A filing? How can we avoid 9A filing?
So Praveen, basically 9A form that you need to file with the tax authorities is for the incomes that you have accrued for the year, but you have not received, and that's the reason you are not eligible to apply those in the current year. So in case, for example, if you are also engaged in any other activities apart from the from receiving the donations, and any of the receipts you are receiving in the, let's say, current year, so you have accrued those in your books, but the receipts in the bank has been received in the next financial year. So in that case, you need to file this Form 9A with the tax authorities and tell them that the reason that you couldn't apply these funds in the current financial year is because you have not received it. So that's the only way you need to file Form 9A. You cannot avoid it since you have accrued the income in the books.
Thank you. The next question is from Priyanka, who's asking, is there any percentage of donation received which we can spend for maintenance of website and social media accounts of NGOs?
So Priyanka, as such, there is no standard percentage which have been given in any of the statutes which you can refer to. and which can be termed as a considerable spend on such activities. So there is no as such specified percentage.
And Dhaval, to add to that, I think the question would be relevant if this was an FCRA limit. And Priyanka, under FCRA, there is a limit that you cannot spend more than 50% of the total amounts on administrative activities, which is where a website and a social media account maintenance would be covered. So under the income tax limits, there is no percentage specified. But under FCRA, all such administrative expenses have to be less than 50% of total spend.
I hope that answers your question, Priyanka. Santosh is asking another question, which is, can the trust sell the products and services? If yes, what should be the maximum cap for the sale of product?
So Santosh, that's a very specific question. We would require some more details. But in case if those activities are related to your main objects of a charitable nature, then yes, you can sell any product or a service which are ancillary to your charitable activities.
And to add to that,
Yeah.
you would obviously separately need to understand the implications of GST. As we mentioned in the beginning, selling of products or services may still be a charitable activity for the purposes of income tax, but will not be a charitable activity for the purposes of GST.
Santosh, to also, if you would like to know more about GST, we have another webinar that was conducted by Suhail and Dhaval. I could send you the link to the same on your email post this webinar. The next question is from Helen, is asking, can a charitable trust invest its corpus in mutual funds?
So Helen, even a charitable trust will not be eligible to invest its corpus funds into mutual funds because end of the day, the mutual funds do invest in the stock market also. So any funds who are based on the stock market or investing in the stock market, so charitable trusts are not allowed to invest in such instruments.
Okay. The next question is from Pritika, who's asking, is audit avoidable and is it okay to just file the annual IT returns? What would be the constituents of an audit?
Pritika, an audit, whether avoidable or not, would depend on the kind of structure you're incorporated under. So, if there is a trust, you may still not be required to get yourself audited. But if it's a society or a Section 8 company, then the relevant statutes would typically require a mandatory audit. An IT audit is anyway mandatory if you are a trust, society, or Section 8 company, if you are tax exempt. So the statutes under tax provisions would typically require for such an independent audit to ensure that the money which has been received and which has been spent is within the objects for which the organization was created and also complies with the tax provisions under Section 11 and Section 12. So there is no exemption from an IT audit if you are registered. However, from a company audit or a society audit, you will be exempt if you are not such an entity and you're purely a trust. And the latter part of the question, we were unable to follow. What would you mean by constituents of an audit? If you mean types of audit, as we clarified, there is a mandatory IT audit, which means a mandatory tax audit, and a mandatory audit per the Societies and the Companies Act.
Thank you so much. We have another question from Ajit. Do we require to take PAN copy from donors paying in cash? What is the limit for cash donations that we can receive?
Ajit, from my immediate recollection, the limit has been significantly reduced. And if I'm not mistaken, you cannot take more than rupees 2,000 in cash as a donation.
I hope that answers your question, Ajit. Vikas is asking, can an organization be set up for promotion of the sector, say fundraising capacity promotion for the NGOs, but this prescribes some activities on membership fee basis, fee on some certification. What should the organization be registered as, trust or Section 8? Again, it's a very specific question, but Suhail and Thawal, you can choose how you want to answer this.
No, Vineet, I think I'm with you on that. That's probably a question, Vikas, you'll have to offline address with us. There is no clear answer or there is no simple way to advise trust or Section 8 company. There are a number of parameters which need to be evaluated before any sort of advice is provided on this. So regrettably, but we'd appreciate if this question is addressed offline.
Okay, I think we'll take 5 more questions. So I think there are a few more questions that are there in case if you can be avoiding questions that are repeated. So in case if your questions are not taken, we'll take it offline, but we are just taking some more general questions that have not been asked yet. Santosh has asked what most of the crowdfunding platforms receive funds either anonymous or without PAN card. In this case, what should be the don'ts by the trust? And Suhail and Thawal, if you all can answer the question in terms of what would be the general do's and don'ts in these cases while receiving anonymous funding, that would be great.
So I think the general do's would typically be that you need to have at least the name, address, and some form of identity available with you. The requirement to have the PAN card, although is not mandatory per the tax provisions, but is always advisable whenever there are significant amounts being received. Again, crowdfunding platforms, you'll have to appreciate that there are the anonymous donation limits, which means the 5% or 1 lakh. So you'll have to work within those guidelines in case there are anonymous donations where, in spite of your best efforts, you're unable to trace them. Otherwise, worst case scenario, you'll just end up in a situation where you have to pay tax on the anonymous donations. So, in summary, that's really what we can advise. You'd have to better address that with the platform itself, as most platforms which are based in India tend to do actually provide and comply with these requirements.
Thank you. Praveen is asking, what's the difference between deferred revenue and accounts receivable?
Praveen, the deferred revenue, you mean that the revenue which you are deferring or you are shifting to a future period. And the accounts receivable means you have already provided the services and for which you are supposed to receive the funds or collect the funds from the person you provided services to. So that's the difference.
Thank you so much. We'll take one last question from Praveen, who's again has a very a similar question, which is please explain the revenue recognition and matching principles.
Praveen, regrettably, this is an extremely long question, and this would be fundamentally an accounts topic, and we could address that at an independent level. But considering the audience and considering this webinar is primarily for tax queries, we'd defer this question for later, please. Apologies, but in the interest of time and everyone else who's on the call, we'd have to take this separately.
In that case, I will take one more question from Ajit, who's asking, just a second. Sometimes donors deny to give PAN copy in case where they have paid by checks. Is it okay from the IT point of view?
Again, Ajit, it's something which is depending on the materiality of the amount. If it's a significantly large contribution, then it would be advisable to always take a copy of the PAN. But if it's an insignificant amount in the context of the overall donation received, you might get away without having a PAN copy.
Okay, that brings us to the end of the webinar. Thank you so much, Suhail and Dhaval. That was very informative and helpful. I'm sure this session has managed to address many of your questions that your NGOs have around income tax. And as we've mentioned earlier, please feel free to email us with any questions that you still have on the matter. A feedback form will be shared, and you can also put down your unanswered questions on the feedback form. And Suhail and Dhaval have very generously actually agreed to answer these questions offline. Please, I will also be sending out the links to the previous webinars for some of the participants who've requested for the same. Please do fill out the feedback form, and I will see you at the next webinar. Till then, thank you for your participation. Goodbye.